Hello everybody, William Jordan here from the Moneymaker channel. Sorry about the mess in my house, okay, it was my birthday, I still have some cleaning up to do. But let's go on with some technical analysis and candlestick patterns going today into the Doji. So like the other candlestick patterns we saw so far, the Doji is a reversal pattern, and like the other reversal patterns that we saw, it is made up of a single candle, and the wicks can be of different lengths. However, unlike the other reversal patterns, the Doji can be considered to be either bullish or bearish, depending on where it is found. If the Doji is situated within an uptrend, it can be considered a bearish reversal pattern, and if it is situated within a downtrend, it can be considered a bullish reversal pattern. So let's talk about the body of the Doji, or rather the lack thereof. Let us start by looking at this green candle first. We can see the opening price right over here, where the bears pushed the price to the lows of the candle, but then the bullish sentiment came back in, driving the prices up to the highs before a small amount of bearish sentiment took over, and then the price closed right over here. As we can see, overall, this is clearly a bullish candle. Now for the Doji. The price opened up right here. At some point there was bearish sentiment in the market, which drove prices down to the lows, before bullish sentiment once again came back in, pushing the prices up to the highs right over here. Then for some reason or the other, the sentiment was reversed once again, bringing prices down to the close at the same price level as the open. Or vice versa, maybe the bulls came in first and then the bearish sentiment took over. It can go both ways. So even though there doesn't seem to be a body of the candle, there is. Only the opening and closing prices are situated at the same level. Now, does this need to be exact? No, not necessarily. Like I say many times, nothing is 100% sure all the time. But in perfect market conditions, for a Doji, the opening and closing prices need to be at the same spot. Let's say that if it looks like a Doji, it probably is, even though there could be a small body. So as you can see, with a Doji candlestick pattern, there is no definitive victory for either the bulls or the bears. And for this reason, many times one could find Doji candlesticks in sideways ranging markets. However, if the Doji is situated within a sideways moving market, it is not a valid reversal pattern. It has to be situated either within an uptrend or within a downtrend. Now, as an example, if a Doji candlestick pattern is situated within a downtrend, we can see there is no clear victory for either the bulls or the bears, so we have to wait for the confirmation before placing our trades. Aggressive traders will enter as soon as prices trade above the Doji candlestick pattern. More conservative traders will wait for prices to close above the pattern, or even wait for a whole candle to have traded above the Doji candlestick reversal pattern. Now the exact opposite is true for an uptrend. We see the Doji reversal pattern happen, and we have to wait for the market turnaround as confirmation before placing our trades. Aggressive traders will enter as soon as prices trade below the Doji candlestick pattern, and more conservative traders will once again wait a bit longer for prices to close or even whole candle to trade below the Doji reversal pattern. Now remember, in sideways ranging markets, many Dojis can be found, since it does show indecision between the bullish or bearish sentiment, and we should probably leave those patterns alone until we can get a clearer image about the market sentiment. However, because of the indecision between the bulls and the bears, a Doji reversal pattern, if situated within a trend, can be a strong indicator for traders out there. The indecision can also make markets go from a trend into a sideways ranging market, and that is the whole reason why we have to wait for confirmation before placing any trade. Let's quickly have a look at three common variations of Doji candlesticks. The common Doji we just saw, the price opened right here, and the bulls and the bears had the same amount of overall drive before the price closed again at the same point. Once again, it does not have to be perfect, and the wicks can be of various lengths. We can find dojis with extremely long wicks. We call them long-legged dojis if you want to. That's fine with me. But there is no clear pattern to it, so do not trade this pattern unless it is within a trending market. Then we get the gravestone doji. Prices opened up right here, and the bulls drove the prices up to the tip of the wick before bearish sentiment reversed the price action and made prices drop to the close right over here. As you can probably guess, the gravestone doji will be found more often than not at the top of an uptrend and therefore can be considered a bearish reversal pattern. Then of course there is the dragonfly doji, which is the exact opposite of the gravestone doji, where the initial price action was driven by the bears down to the tip of the wick before bullish sentiment made the prices go up once again to the close at the same level as the opening price. This candlestick will mostly be found at the bottom of a downtrend, and hence it is mostly considered a bullish reversal pattern. So how would you trade the doji reversal pattern? For the high frequency traders out there, let's have a look at Amazon on a 3-minute chart. We can clearly see a nice uptrend going here, and even from previous price action there was an uptrend. But then we get to something that seems a bit like a gravestone doji, but the market didn't quite turn around yet, but there was some indecision. But then all of a sudden we do find the common doji right here at the top. Now if you were in a long position, this could be a good place to exit your trade, or at least move your stop loss in a bit tighter, just in case there is market turnaround and the price action will flip sides going into a more bearish sentiment, as it happened right over here. If you were in no position, this could be a good place to enter into a short position. Now like I said, aggressive traders will trade as soon as prices trade below the doji reversal pattern. More conservative traders will wait for prices to close below the pattern, and even more conservative traders will have waited for a whole candle to have traded below the doji reversal pattern. However way you would have traded this, you could see that you could have made some decent amount of earnings on this trade if you traded the doji reversal pattern. Okay, so let's look at Netflix on a 15-minute chart. Here there is some noise in the market before we get into a strong bearish sentiment, dropping the prices down overnight and into the early mornings of the next day. And then there is a lot of noise going around here. But all of a sudden we do have a short-term trending market to the bottom where we see our doji reversal pattern. Now this is not a perfect doji reversal pattern. As you can see, there is a small body, but like I said, it's never 100% sure. If it looks like a doji, it probably is a doji. Now if you were in a short position, this would have been a good place for you to exit your trade, but if not and you wanted to go into a long position, aggressive traders would have entered as soon as prices traded above the doji reversal pattern. More conservative traders would have waited for prices to close above the reversal pattern, and even more conservative traders would have waited for a whole candle to trade above the doji reversal pattern. In that case, however, they would not have made too much unless they waited for a pretty long time to get to the next upward move right over here. But we do see there is a lot of noise going on in the market right here. Now let's look at a third example, Facebook on a 5-minute chart, just to give you guys an example of things not necessarily going the way you would want them to. Now there is some small amount of uptrend going on here right at the beginning, but then the market goes into a sideways ranging market. Now there is something that kind of resembles a gravestone doji here, but since it is not clearly situated within an uptrend, we're better off not trading that one. If, however, you did trade on this gravestone doji pattern, you would have been squeezed out right in the beginning over the next 2 candles, and it would not have been a fruitful trade for you. We also see there's a doji pattern right over here, but since it is in a sideways ranging market and there is no clear definitive way of knowing which way prices would be going, you're better off not trading on this doji pattern right here. We have to wait to get a clearer image of how the market is going to go forward before we get into a trade. So there you have it, guys. This was just a quick video on doji reversal patterns. Like I mentioned many times throughout the video, if it is situated within a sideways ranging market, doji patterns are not valid reversal patterns and you're better off not trading them. You have to wait for a doji to be situated within a trend, either uptrend or downtrend, in order for it to be a valid reversal pattern. And you have to wait for your confirmation. Remember, since there is no clear win between the bulls and the bears when we talk about dojis, it's almost like a neutral sentiment, I can say. If it is situated within a trend, there is a chance of the market going into a sideways ranging market. So remember, for goodness sakes, remember placing your stop losses just in case the market doesn't go the way you wish and ends up going down once again after the ranging market conditions. I hope this video was informative for you. I hope you guys know a bit more about dojis right now. If you liked my video, remember, please click that like button down below, subscribe, share it with your friends. I would appreciate it. I really want to get more information about trading and investing out there. So far, we're only talking about trading. But yeah, and now you guys can go out and look at the different softwares you have, look at different maps, stock charts over different time periods, try to spot doji reversal patterns, see how you would have traded them, and you would probably notice there's more dojis within ranging markets. That's normal since there is no clear definitive win between the bulls and the bears. It's a period of indecision. So go spot those, go see how you would have traded the reversal patterns, how it would have turned out, how it would have turned out bad if it did, and leave me a comment down below. I would appreciate it. This was William Jordan from the Moneymaker channel. See you all in the next video.